I do want to switch gears a little bit and take it to where we are in the market right now. The market psychology differs depending upon where we are in the cycle. And in our conversation sort of before the interview, you said we've been late cycle for 3 years. Yeah. So I'd love to touch on how market psychology changes and how, as an individual investor or trader, you have to adapt your process and your outlook in psychology depending upon where we are at different points in the cycle, with specific focus on this time. So I'd love to hear about earlier in the cycle, but really we're in this late cycle period where people want to call tops on the markets. They want to get short, and really you can get hurt. You can get hurt, especially if you're not willing to admit when you're wrong or know when you're right, whatever it may be, whichever one it is. So I'd just love to hear your take on that.
So, it's interesting. You hear these people trying to call the top and the bottom of the markets. It reminds me of the old saying that a broken clock is right twice a day, right? You keep calling a market crash, eventually you're going to be right. And you keep calling a big bull, you're going to be right eventually, right? So it's really fascinating. But the more interesting psychology to me about late cycle psychology is one psychology we call the self-fulfilling prophecy. It's that you look at the charts and you look at historical data and you say, well, these cycles tend to last 10 years, and here we are, 10 years. And so people then start projecting and engaging in behaviors that cause the very thing that their beliefs think should happen. But that's why so many people have gotten burned the last few years. Because I was playing golf with an investor, a seasoned, wealthy investor, 2.5 years ago. I'll never forget, a summer. And he said, boy, this market's gonna have to correct 20 to 30% soon. That was 40% ago. So even the best investors in the world, they're trying to call the market. It's just because you never know when the next innovation is going to happen, the next tax cut. You never know when a coronavirus is going to come in or a blindsided event. And so trying to call the market is historically a losing game. Now, with that said, it doesn't mean you don't pay attention to factors. You don't pay attention to headwinds and tailwinds. You have to factor all those things in. One of the things I really like about the idea of fundamental investing. I'm not saying it's the best way to invest or the only way, but one of the things I like about it is it's data driven, right? You're dealing with facts, and you're having to make bets and take risk, but you're mitigating the amount of conjecture and the amount of projection of the individual. So if the data pattern tells a story and your beliefs are over here and the facts are telling you a different story, you have to try to square that circle. The reality is, we're late cycle, there's no doubt. But prior to 2008, for example, you could see the factors that could lead to a market collapse. A lot of people were caught off guard by that. It was irrational exuberance, for sure. Are you seeing a lot of the human psychology patterns again today? Absolutely. I was in Boulder, Colorado 2 days ago. $4 million houses in a college town. Ubiquitous, everywhere. $1 million houses in a college town with no real economy. What economy does Boulder have, right?
They got VCs.
They got VCs, some VCs, they've got a university, but what sustains $4 million houses, all over Boulder? It's even $2 million houses. Where's the money coming from? Obviously, you look at the student debt crisis right now, which is a multiple of the housing crisis that collapsed us in 2008. But it's a known. It's a known thing. That's why it's a big topic in the election. But I think the people who are investing today were generally around in 2008. Once bitten, twice shy. Whereas prior to 2008, a lot of those people were new investors, hadn't really gone through a crisis. They got their clocks cleaned. The way I'm observing people nowadays is really, really different. There's more fear, but healthy fear, more scrutiny, more discipline, more hedging, better risk. So when you have all those controls in place, you don't buy into a narrative just because it's happened before. It doesn't mean it happens again. Markets rhyme; they don't repeat. And so ground yourself in facts. Be a student of the history of the markets. Be a student of human behavior and how people tend to react late cycle, mid cycle, early cycle. And when you start looking around, you see those behaviors. That's opportunity. When people are willing to capitulate over. Right now, for example, people are willing to capitulate over any shift in the market because they've already convinced themselves the party's over. And so any drop in the market has to be the end. And so they pull all their cash out. This might be 1 year, 2 years, 5 years. We might be in a historical innovative cycle. And if Trump wins again and continues to be as business and market friendly as he has been, there's no reason this has to end. Now, I'm not saying it's going to be good for the environment. I'm not saying it's going to a win by Trump is necessarily going to be good for PR, or for the view of America. But there's no necessarily compelling reason that this party has to end, that this bull market has to end. I mean, the jobs reports are great. The economy is really healthy. People have a lot of money. They're spending that money. And they're saving it, right? So 401ks are still at all-time highs, but the consumer confidence remains high. So all the things that tend to anticipate or be in advance of collapses are not there, except for the fact that, the party should end around midnight.
That really echoes something that, a contributor who came on recently for the first time, who is a high achiever, Jeff Green, who is a billionaire real estate investor, who a lot of the things that you're talking about mentality and psychology, he kind of echoed in his own story of success. And then when we, asked him about his view on the market, he really did take that sort of, historically it says the party should be over, but there are all of these factors that say maybe it could go on. And let
me say one more thing about that, if you don't mind, Matt.
Yeah, go ahead.
And this is something that Steve Cohen always says, is you can't play in the major leagues of baseball with one pitch. Like, you have to have a second pitch and a third pitch. Same with golf. The great thing about Tiger Woods is he could win with his length off the tee. He could win with his short game. He could win with his putting. There's so many different ways he won golf tournaments. Participate in the markets and run your process in the bull market, but have a second pitch. So if the market does shift, you have a strategy that can function in that market as well, or get out of the game. But you can't win forever with one pitch in dynamics, evolving, shifting, changing markets. So I'll say that.